Hello everyone. Today's screen study is about adjusting entry, and we are going to study about adjusting entry through these four parts: definition, purpose, rules, and the four types of adjusting entry. Let's start by definition. Adjusting entry, a journal entry made at the end of an accounting cycle to update certain revenue and expense account and to make sure comply with the matching principle. The purpose of adjusting entry is to account for transactions that have not been recorded by the end of the period, to record revenue in the period earned, and to record expense in the period they are incurrent to generate those revenue, to correctly state assets and liabilities. There are three adjusting entry rules. First of all will be adjusting entry will never include cash. Second, usually the account adjusting entry will only have one debit and one credit. The adjusting entry will always have one balance sheet account, asset, liability, or equity, and one income statement sheet, revenue or expense, in the journal entry. There are four types of adjusting entry: deferred revenue, accrued revenue, deferred expense, and accrued expense. They are described as money was received in advance of having been earned, and the revenue have been earned but the sale invoice have not yet been paid. The money was paid for the future expense, and the expense have been incurred but the invoice have not been completely paid. And the change in asset, liability, and equity shown as the table. The deferred revenue decrease the liability, increase the equity, and the accrued revenue increase both the asset and the equity. The deferred expense decrease asset and equity at the same time, and the accrued expense increase the liability but decrease the equity. Thank you for your listening.